Question 1. In Missouri, what is the minimum free look period for a new life insurance policy? A. 5 days. B. 10 days. C. 14 days. D. 20 days. Answer: B. 10 days. In Missouri, policyholders have a minimum of 10 days after receiving a new life insurance policy to review it and decide if they want to keep it. This free look period allows an applicant to return the policy for a full refund of any premiums paid, providing a safety net and ensuring they are comfortable with their purchase. This provision helps protect consumers from feeling pressured into a decision and ensures they have ample time to understand the policy's terms. Always remind clients about this crucial right to review their policy without obligation. Question 2. An insured individual misstated their age on a life insurance application. If the insurer discovers this after the policy has been in force for a period, what will most likely happen upon the insured's death in Missouri? A. The policy will be voided, and all premiums will be forfeited. B. The policy will be adjusted to pay a reduced death benefit based on the correct age. C. The policy will be adjusted to pay an increased death benefit based on the correct age. D. The insurer will charge the beneficiary the additional premiums that should have been paid. Answer: B. The policy will be adjusted to pay a reduced death benefit based on the correct age. The misstatement of age or sex provision in a life insurance policy states that if an insured's age or sex was misstated, the death benefit payable will be adjusted to the amount that the premium would have purchased at the correct age or sex. For instance, if the insured was older than stated, the death benefit would be reduced because older individuals typically pay higher premiums for the same coverage amount. This ensures fairness for both the insurer and the policyholder, preventing an individual from obtaining coverage at a rate lower than they qualify for. Always confirm an applicant's correct age to prevent future benefit adjustments. Question 3. Which of the following is not a characteristic of a variable life insurance policy? A. It has a fixed, guaranteed death benefit. B. It has separate accounts that hold investment funds. C. Policy owners bear the investment risk. D. It requires a securities license to sell. Answer: A. It has a fixed, guaranteed death benefit. Variable life insurance policies are unique because their cash value and death benefit can fluctuate based on the performance of the underlying investments, which are held in a separate account. Unlike traditional whole life policies, the death benefit is not fixed or guaranteed. It has a minimum guaranteed death benefit, but it can increase or decrease based on investment performance. This means the policy owner assumes the investment risk, and agents selling these products must hold both a life insurance license and a securities license, FINRA Series 6 or 7. Remember that variable implies investment risk and potential fluctuation, distinguishing it from traditional guaranteed products. Question 4. In Missouri, what is the primary purpose of the incontestability clause in a life insurance policy? A. To allow the insurer to contest the policy at any time for fraud. B. To prevent the insurer from denying a claim based on misrepresentations after a certain period. C. To permit the policy owner to make changes to the policy terms after it has been issued. D. To require the policy owner to undergo a medical examination every 2 years. Answer: B. To prevent the insurer from denying a claim based on misrepresentations after a certain period. The incontestability clause states that after a life insurance policy has been in force for a specific period, typically 2 years in Missouri, the insurer cannot deny a claim due to material misrepresentations made in the application, even if they were fraudulent. For example, if an insured failed to disclose a medical condition and died 5 years later, the insurer generally could not contest the claim. This provision protects beneficiaries by ensuring that death benefits are paid without undue delay or challenge years after the policy was issued. It provides peace of mind that valid claims will be honored once the contestability period passes. Question 5. A life insurance policy's grace period in Missouri typically allows the policy owner how much additional time to pay a past due premium before the policy lapses? A. 7 days. B. 10 days. C. 20 days. D. 30 days. Answer: D. 30 days. The grace period is a stipulated amount of time, usually 30 or 31 days in Missouri for life insurance, after the premium due date during which the policy remains in force even if the premium has not been paid. If the insured dies during this grace period, the death benefit will still be paid, minus any unpaid premiums. This provision prevents a policy from lapsing immediately due to a slight delay in premium payment, offering a safety net for policy owners. It's a critical consumer protection feature that ensures continuous coverage for a short time after a missed payment. Question 6. All of the following are typically considered settlement options for life insurance policy proceeds, except A. Lump sum cash. B. Interest only. C. Paid-up additions. D. Fixed period. Answer: C. Paid-up additions. Settlement options describe how the death benefit proceeds from a life insurance policy will be paid out to the beneficiary after the insured's death. Common settlement options include receiving the entire amount as a lump sum, having the insurer hold the proceeds and pay out only the interest only, or distributing the proceeds over a specified period, fixed period, or in fixed amounts, fixed amount. Paid-up additions, however, are a dividend option where dividends are used to purchase small, single-premium policies that add to the existing coverage, not a way to receive the death benefit. Understanding settlement options helps beneficiaries choose how to best manage their inheritance. Question 7. What is the main purpose of the entire contract provision in a life insurance policy? A. To allow the insurer to add or remove provisions as needed. B. To state that the policy document and the application constitute the complete agreement. C. To define which parts of the contract are legally binding. D. To outline the specific conditions under which the contract can be terminated. Answer: B. To state that the policy document and the application constitute the complete agreement. The entire contract provision in a life insurance policy stipulates that the policy document itself, along with the attached application, forms the complete and exclusive agreement between the policy owner and the insurer. This means that no other documents, oral statements, or external agreements can be considered part of the contract. For example, if an agent made a promise not written in the policy, it would not be enforceable under this clause. This clause protects both parties by ensuring that all terms and conditions are clearly defined within the policy, preventing disputes over unwritten agreements. Question 8. Which non-forfeiture option allows a policy owner to use the cash value to purchase a single premium, paid-up whole life policy for a reduced amount of coverage? A. Cash surrender value. B. Extended term option. C. Reduced paid-up insurance. D. Automatic premium loan. Answer: C. Reduced paid-up insurance. Non-forfeiture options are choices available to a policy owner when they decide to discontinue paying premiums on a permanent life insurance policy that has accumulated cash value. With the reduced paid-up insurance option, the accumulated cash value is used as a single premium to purchase a new, fully paid-up whole life policy with a lower face amount than the original policy, but it continues to provide coverage for the remainder of the insured's life. This is a great choice for someone who wants to stop paying premiums but still desires lifelong coverage, albeit for a smaller death benefit. Remember, paid up signifies no more premiums are due. Question 9. An insured in Missouri has a participating life insurance policy. Which of the following best describes what participating means for this policy? A. The policy pays dividends to the policy owner. B. The policy owner can participate in investment decisions. C. The policy allows for policy loans only if the policy owner participates in a financial literacy program. D. The policy's cash value is guaranteed to increase by a fixed percentage each year. Answer: A. The policy pays dividends to the policy owner. A participating life insurance policy is one issued by a mutual insurance company that allows the policy owner to participate in the company's divisible surplus through the payment of dividends. These dividends are essentially a return of a portion of the premium if the company's actual mortality, expense, and investment experience is more favorable than anticipated. For example, a policyholder might receive an annual check or have the dividend used to reduce future premiums. Non-participating policies, typically issued by stock companies, do not pay dividends. Question 10. Which of the following describes the legal concept that prevents a beneficiary from assigning the proceeds of a life insurance policy to a creditor? A. Spendthrift clause. B. Assignment clause. C. Reinstatement provision. D. Collateral assignment. Answer: A. Spendthrift clause. A spendthrift clause is a provision in a life insurance policy's settlement options that protects the proceeds from the claims of the beneficiary's creditors. It prevents the beneficiary from assigning, pledging, or encumbering the proceeds before they are actually received, ensuring the death benefit is paid directly to the intended recipient without intervention from debt collectors. For example, if a beneficiary has significant debts, this clause prevents creditors from seizing the life insurance payout directly from the insurer. This clause helps ensure the financial security intended for the beneficiary remains intact. Question 11. In Missouri, an agent replacing an existing life insurance policy must provide the applicant with which of the following? A. A copy of the new policy within 5 business days of application. B. A notice regarding replacement. C. Proof that the existing policy is inadequate. D. A guarantee that the new policy will have lower premiums. Answer: B. A notice regarding replacement. When an agent recommends replacing an existing life insurance policy with a new one, Missouri regulations require the agent to provide the applicant with a notice regarding replacement. This document educates the consumer about the potential disadvantages of replacement, such as new contestability periods, higher premiums due to age, or loss of accrued cash values, and advises them to compare the existing and new policies carefully. This disclosure is crucial because replacement can often be detrimental to the policy owner, so thorough disclosure is vital for consumer protection. Always remember that the focus is on protecting the consumer from potentially harmful practices. Question 12. Which of the following is not a required uniform provision in an individual life insurance policy in Missouri? A. Grace period. B. Suicide clause. C. Policy loan provision. D. Automatic premium loan provision. Answer: D. Automatic premium loan provision. While a grace period, suicide clause, and policy loan provision are all standard and often required uniform provisions in individual life insurance policies, the automatic premium loan (APL) provision is typically an optional rider or feature, not a mandatory uniform provision. The APL allows the insurer to automatically borrow from the policy's cash value to pay a premium that is due, preventing the policy from lapsing. Though beneficial, it is a choice made by the policy owner, not a mandated part of every policy contract. Question 13. A policy owner has a permanent life insurance policy and wants to borrow money from it. This is possible due to which policy provision? A. Reinstatement provision. B. Policy loan provision. C. Dividend option. D. Accelerated benefits rider. Answer: B. Policy loan provision. The policy loan provision allows a policy owner to borrow money directly from the cash value accumulated within a permanent life insurance policy. The loan amount cannot exceed the policy's cash value, and interest is charged on the loan. For example, if a policy has $10,000 in cash value, the owner might be able to borrow up to that amount. This is a common way for policy owners to access their policy's value without surrendering the policy, and any outstanding loan balance plus interest is deducted from the death benefit if the loan is not repaid before the insured's death. Question 14. What is the primary purpose of a viatical settlement? A. To allow a healthy policy owner to sell their policy for more than its cash value. B. To provide funds to a terminally ill policy owner by selling their life insurance policy. C. To allow a beneficiary to receive the death benefit before the insured dies. D. To convert a term life policy into a whole life policy. Answer: B. To provide funds to a terminally ill policy owner by selling their life insurance policy. A viatical settlement involves a terminally ill policy owner selling their life insurance policy to a third party for a cash amount that is less than the policy's face value but more than its cash surrender value. This provides immediate financial liquidity to individuals facing a short life expectancy to cover medical expenses or improve their quality of life. For instance, a person with a terminal illness might sell a $100,000 policy for $60,000 to cover medical bills they otherwise couldn't afford. This serves as an important option for those needing access to their policy's value during a critical health crisis. Question 15. In Missouri, all of the following are examples of unfair trade practices except A. Defamation. B. Rebating. C. Replacement. D. Misrepresentation. Answer: C. Replacement. While replacement of an existing life insurance policy with a new one is highly regulated and requires specific disclosures in Missouri to protect consumers, it is not inherently considered an unfair trade practice. Defamation, making false statements about an insurer's financial condition, rebating, offering a portion of the commission as an inducement to purchase a policy, and misrepresentation, false statements about policy terms or benefits, are all examples of prohibited unfair trade practices designed to protect the public and promote fair competition. The key is that replacement is permissible if done ethically and with full disclosure, unlike the other listed activities which are always prohibited. Question 16. Which type of life insurance policy offers the greatest amount of death benefit for the lowest initial premium? A. Whole life. B. Universal life. C. Term life. D. Variable life. Answer: C. Term life. Term life insurance provides coverage for a specific period, the term, and pays a death benefit only if the insured dies within that term. It does not accumulate cash value, which makes its premiums significantly lower than permanent policies like whole life or universal life for the same death benefit amount, especially at younger ages. For example, a 30-year-old might purchase a $500,000 20-year term policy for a fraction of the cost of a whole life policy with the same death benefit. If you need maximum coverage on a budget, term life is generally the most cost-effective option initially. Question 17. In Missouri, if a life insurance applicant is considering a variable life insurance policy, what is the producer required to do regarding suitability? A. Guarantee a specific rate of return on the policy's investments. B. Obtain information to determine if the policy is suitable for the applicant's financial situation and objectives. C. Advise the applicant to invest all their savings into the policy. D. Provide a list of all other variable life policies available in the market. Answer: B. Obtain information to determine if the policy is suitable for the applicant's financial situation and objectives. When recommending a variable life insurance policy, which involves investment risk, the producer has a strict suitability obligation. This means they must gather sufficient information about the applicant's financial situation, investment experience, risk tolerance, and objectives to ensure that the recommended policy is appropriate for them. For example, a producer should not recommend a variable policy to someone with no investment experience and a low risk tolerance. This requirement protects consumers from being placed into products that do not align with their financial needs or risk profile. Question 18. What is the typical effect of a suicide clause in a Missouri life insurance policy? A. The policy will pay double the death benefit if the insured commits suicide. B. The policy will be voided if the insured commits suicide at any time. C. If the insured commits suicide within a specified period, example 2 years, the insurer will only return the premiums paid. D. The insurer will pay the full death benefit regardless of when the suicide occurred. Answer: C. If the insured commits suicide within a specified period, example 2 years, the insurer will only return the premiums paid. The suicide clause in a life insurance policy typically states that if the insured commits suicide within a specific period, usually 2 years from the policy's effective date, the insurer's liability is limited to a refund of the premiums paid. If the suicide occurs after this period, the full death benefit will usually be paid. This clause is designed to deter individuals from purchasing a policy with the immediate intent of suicide. For instance, if an insured commits suicide 18 months after purchasing a policy, the beneficiary would only receive the premiums paid, not the face amount. Question 19. A life insurance policy that allows the policy owner to vary the amount of premium payments and adjust the death benefit is known as A. Whole life. B. Term life. C. Universal life. D. Endowment policy. Answer: C. Universal life. Universal life insurance is a flexible permanent life insurance policy characterized by its adjustable premiums and death benefits, and its transparent separation of cash value, protection, and expense components. Unlike whole life, policy owners can often increase or decrease premium payments within certain limits and also modify the death benefit. For example, if a policy owner experiences a financial hardship, they might reduce their premium payment or use accumulated cash value to cover the cost of insurance. This flexibility is a key feature distinguishing it from more rigid whole life policies. Question 20. Which type of life insurance allows the policy owner to surrender the policy for its cash value at any time? A. Term life. B. Decreasing term life. C. Annual renewable term life. D. Whole life. Answer: D. Whole life. Whole life insurance is a type of permanent life insurance that provides coverage for the insured's entire life and builds cash value over time. A key feature of whole life is that this cash value is guaranteed to grow and can be accessed by the policy owner through policy loans or by surrendering the policy. Term life insurance, by contrast, does not build cash value and therefore offers no surrender value. If a policy owner with a whole life policy no longer needs the coverage, they can surrender it and receive the accumulated cash value, minus any outstanding loans or surrender charges. Question 21. What is the primary role of the Missouri Director of the Department of Commerce and Insurance regarding insurance? A. To sell insurance policies to the public. B. To promote specific insurance companies. C. To regulate the insurance industry for the protection of the public. D. To resolve all contractual disputes between insurers and policy owners without court intervention. Answer: C. To regulate the insurance industry for the protection of the public. The primary responsibility of the Missouri Director of the Department of Commerce and Insurance is to regulate the state's insurance industry to protect the interests of policyholders and the general public. This includes licensing agents and insurers, approving policy forms and rates, investigating consumer complaints, and enforcing insurance laws and regulations. For instance, if an insurer is found to be engaging in unfair practices, the director has the authority to issue penalties. The director acts as the chief insurance regulator, ensuring fair and stable insurance markets within the state. Question 22. Which of the following statements about group life insurance is true? A. Individual members receive a separate policy document. B. Coverage is typically more expensive than individual policies. C. The employer usually pays all or part of the premiums. D. Evidence of insurability is always required for all members. Answer: C. The employer usually pays all or part of the premiums. Group life insurance is often provided by employers to their employees as an employment benefit, with the employer typically paying all or a portion of the premiums. This type of coverage is usually less expensive than individual policies because the risk is spread across a large group, and individual members generally receive a certificate of insurance, not a separate policy. For example, a company might offer a basic level of group life coverage to all employees without requiring individual medical exams. It's a common and cost-effective way to provide life insurance benefits to many people simultaneously. Question 23. If a Missouri life insurance policy owner decides to make a collateral assignment of their policy, what does this mean? A. The policy owner gives up all rights to the policy permanently. B. The policy is used as collateral for a loan, and the creditor has a temporary right to the death benefit. C. The policy owner can change beneficiaries without the insurer's permission. D. The policy's cash value is automatically paid out to the policy owner. Answer: B. The policy is used as collateral for a loan, and the creditor has a temporary right to the death benefit. A collateral assignment of a life insurance policy means the policy owner pledges a portion or all of the death benefit as security for a debt or loan. The policy owner retains all other rights to the policy, and the assignment is temporary. It terminates once the loan is repaid. For example, a small business owner might assign a portion of their life insurance policy to a bank as collateral for a business loan. This is a common way to leverage the value of a life insurance policy without fully surrendering it. Question 24. Which of the following is an example of defamation in the insurance industry? A. An agent offering a prospective client a portion of their commission as an inducement to buy a policy. B. An agent making a false or maliciously critical statement about another insurer's financial condition. C. An agent falsely stating that a policy's dividends are guaranteed. D. An agent replacing a client's existing policy without proper disclosure. Answer: B. An agent making a false or maliciously critical statement about another insurer's financial condition. Defamation in the insurance industry refers to the act of making false, maliciously critical, or derogatory statements, either orally or in writing, about the financial condition of an insurer or an agent. This practice is prohibited because it can harm the reputation of competitors and mislead the public. For example, an agent spreading a rumor that a competitor is on the verge of bankruptcy, knowing it's untrue, would be committing defamation. Maintaining professionalism and honesty is crucial, and such actions are considered unfair trade practices. Question 25. Which rider would typically provide an additional death benefit if the insured dies as a result of an accident? A. Waiver of premium rider. B. Guaranteed insurability rider. C. Accidental death benefit (ADB) rider. D. Payer benefit rider. Answer: C. Accidental death benefit (ADB) rider. The accidental death benefit (ADB) rider, also known as double indemnity, is an optional add-on to a life insurance policy that provides an additional death benefit if the insured's death is a direct result of an accident. For example, if the insured has a $100,000 policy with an ADB rider, and they die in a qualifying accident, the beneficiary might receive an additional $100,000, totaling $200,000. This rider is popular for those who want extra protection against the financial impact of an unforeseen accidental death. Remember, this benefit only pays out under specific, accidental circumstances.